Well, hello everyone. It is a few minutes after 12 o'clock, probably closer to 20 after 12 actually, on Thursday, July 24th. And we are here with another edition of Chart the Markets. And today we are going to be talking about fear and greed. We're going to be talking about how it impacts us and how it impacts the markets. And ultimately, we're going to be looking at how we manage it. And what we're going to do is we're going to walk through a quick little, I don't want to call it a tutorial, slideshow of just kind of outlining what fear and greed is and what it does. But before I do that, I do want to thank our really good friends at FEG Token and smartdefi.com. You should head over to smartdefi.com to see what that's all about. If you're looking at creating a token of your own or tokenizing real world assets, that is the place to go. I also want to thank our good friends at BYDFi exchange, BYDFi. A link to that exchange is available of course, on my X profile, and of course at Blunthouse TA on YouTube. You can get it all in the description, and I encourage you to click on that link and sign up. It's a great exchange, and every week we select 2 winners of some trading bonuses each and every time we go on air. So those winners are notified by email. Now, let's talk about fear and greed just a little bit. Now, for starters, no, that's not me in the picture. That guy has way more hair than I do, and no. So just in case you're thinking it is. What are we talking about with fear and greed, right? These are things that influence your decisions. They drive volatility in the markets, and maybe it's fear and greed that are contributing to you making questionable decisions at times. Maybe that's in fact what you're really dealing with. Because all of that psychology and all of that drama, all the things we talk about every week when we get inside our own heads, this is what we're talking about. And you know, how do we manage it? What is it? Well, if you go back to the pandemic back in 2020, everybody was freaking out about everything, including the stock market. And if you recall, it did sell off really, really, really hard, right? And that fear and greed index is measured quite simply from 0 to 100. Closer to 100 you are, the more greed there is. The other side is more fear. And what does it do? Well, it creates this up and down volatility, these spikes in prices that we see. A lot of that is the fear and the greed. And you know, right now, if we look around, it's probably driven by more greed than anything else. Price go up, doesn't matter what happens, but price just goes up, right? Now we can measure that and we can track it, but I think we all understand that perhaps it's a little bit irrational, right? Now, one of the things that I never thought of before was what the fear and the greed does to ourselves as traders. And like signs of fear, hesitation before entering trades. Ever have that happen? Maybe more than once or twice, right? So what is it that you're afraid of? Panic selling during downtrends. Uh-oh. Big red candle. What do I do? Oh, I don't like it. Sell. Now, we can filter that because we work off of Fibonacci's, fractals, and filters. So that big red candle may or may not, may have scared other traders. It may not have scared the ones in here because you understand how to run and trade the T line really well. Sometimes you're sitting in front of your screen and you're like, oh my God, this looks like the perfect setup, and you don't take the trade. It's equally as bad, right? So it's again, it's a sign that we're in our own heads a little too much. What are some of the things we see with greed? Over trading. How many people have done that, right? And that's really revenge trading in a lot of ways, right? We ignore our stop losses. I think we hear that a lot. Oh, I just didn't feel like it. Or, well, it was already down 20%, so I figured, let's see if it turns around, right? And then, of course, there's the FOMO, right? Just chasing everything that goes up or appears to go up, right? Now, we have to manage all of this stuff. This is part of the job, right? Like what we're doing here isn't purely entertainment. This is a job, right? If you're going to do this in any seriousness, treat it like a job. Wake up early in the morning, prepare for the day, maybe work late at night. Whatever you need to do to be efficient, but treat it like a job. And when things aren't going your way, and we talk about this in our trading journals, and there's a reason. If things aren't going your way, take a step back. Right? Go for a walk. The last thing you want to do is overtrade. Right? But document how you feel, what's going on when all of this stuff happens. It doesn't take a long time. It sounds like an arduous task, but it's not. There's little simple things that you can do to become just a better trader. And part of becoming a better trader and a better technician is by managing emotions. Right? If you can manage your emotions, and it might give other people the persona that you're cold, that's not it. Right? You're just managing your emotions and expectations. Right? One of the ways you can do that is through position sizing. Right? Small amounts. Right? Now, a lot of you who are new or don't have a lot of capital to start out with, you're probably not going to risk 1 or 2% because that might feel insignificant. But the takeaway is, do not risk too much. And too much is more than you can afford to, feel like you can afford to lose. And look, you're the only one that can figure that out. But don't risk too much, right? Take profits regularly and frequently and move that money somewhere so that you're not tempted to risk it if that's what you're afraid you might do. There's all kinds of little things that you should do. Just do it. Put your stop losses in. We talk about this all the time. Use a stop loss. And of course, the time you don't use it is the time that you get upside down too quickly and you're probably leveraged. And then at that point, it's all over. Avoid that kind of mistake. Just simply don't make it. Put the bloody stop loss in. Okay? And test everything. Like we show week in, week out, how our system works, how to track price, which is essentially money flow. We talk about treating this like a job. So this is where the routine comes in. Right? So wake up early. I'm instinctively up pretty early. So sometimes too early. And what do? Well, turn my system on and I go to work. I have charts to analyze. I have trades to review, trades to make. Like, it's a job. And part of the job is preparation. Right? Coming home from work and kicking off your shoes as fast as you can and running up to your computer and start placing trades is not professional. It's reckless. Right? And if you want to be reckless, that's fine. Like, there's a place for that. It's just probably not here. We're trying to teach you the right ways to do things. And it might seem tedious and it might seem boring. And maybe your friends are having too much fun on pump, whatever the heck that is. I don't know. I get it. But if you want to learn how to do something right, then continue to pay attention. Because this is why you're here, hopefully. Treat this like a job. The whole practice mindfulness thing, you almost want to laugh at it, but I'll tell you something. You do this long enough, and there are days that you're going to be really stressed out. For one reason or another. Maybe it's just your life. But you have to find a way not to let the highs get too high and not to let the lows get too low. It's all a process. For me, it's, you know what, hook the dog up and go for a walk. It's, you know, it's a way I can clear my head and rethink things. Everybody does something unique to them. Find out what that is and find out how to calm your brain down and slow your heart rate down so that you can become a calmer, instinctful, and more practical trader. So here's what you need to do. Focus on a process, right? Like everyone's got a process and they're all a little bit different, and that's okay. We are all a little bit different. But whatever your process is, be detailed and forensic about how you follow it and create a good habit and repeat it so that it actually does become a habit. That's what we're doing in here when we're looking at our charts, right? Where a lot of this is repetitive and it becomes instinctive. Start there. The losses that you're going to take, learn from them. Here's the key. If you're using stop losses, those lessons will be less painful. And the road to your success will be shorter. Embrace the loss. It's not a bad thing if you get your stop triggered, whether or not you're in profit. The fact of the matter is, you live to trade another day. This is not, it's not a casino, or don't treat it like a casino if you are. Because eventually that will come back to bite you, and probably hard. So get good habits quickly. Don't get discouraged about the losses that you take. If you're mitigating the risk, they won't be too severe. And they'll be light enough that you'll be willing to talk about them out loud. Let's just say that. Recognize the things in yourself that may become problematic to your trading or your analysis. It could be a bias. It could be a million different things. Maybe when you lose, you take that personally, and then you get angry, and then you start to revenge trade, and then it's like, you know how that ends. Not well. If you know that you're like that, then you have to come up with some little tricks to keep yourself from going down that path. And that's an easy say and a hard do, right? That's something that every single one of us are probably working on every day. Because this, again, is a process, right? And every day we learn something, or we try to. Right? Here's what you want to avoid: the revenge trading. This is probably one of the most common things and common mistakes that new traders make. Right? How many of you have doubled down after a loss, or not run your stops? A million different things. All of that is part of what happens when your brain is being driven by the fear and the greed and the uncertainty. Herd mentality. Gotta love this, right? Here we are on social media talking about herd mentality. But there's such a thing called group speak, right? Some of us know it as FOMO, whatever. But group speak is basically where everyone's saying the same thing and everyone's agreeing with the same narrative without doing any sort of digging on whether or not the narrative makes any sense. Right? But just so many people seem to think it's a good idea. How could it be wrong? Well, lots of ways. Right? And then there is the overconfidence. There are pros and cons to this part of your trading journey. The good thing is you got good enough to feel overconfident. The bad news is you're not experienced enough yet to deal with it. And what happens is, as many of you may know, you start taking too much risk, your position sizing gets disproportional, and you start walking up a very slippery staircase, and then all of a sudden you fall. And you really, really, really have to avoid that. The temptation to risk more or take on more lev, whatever the case is, gets really strong. But you have to be sure that you're sticking to your plan, and your plan will include position sizing and risk. And it doesn't matter whether you feel you're having the day of your life because you are a professional and you treat this like a job. You just follow your plan. And again, that's probably an easy say and a hard do, but that's what you need to do in order to become successful ultimately. Right? So master your emotions, manage the risk. We talk about it all the time and we can't stress it enough. And be aware. Be aware of the type of person you are. Right? Taking this on, whether it's a profession or a hobby, one of the things that is common among the people that I know is that they'll all tell you they learned a lot about themselves. They really become very aware of who they are as people, how they manage stress, what kind of risk tolerance they have, how they perceive the assets that they buy. Are they married to them? Do they have any sort of personal relationship to them? Are they attached, or is it just a trade? All of that stuff you're probably unaware of when you walk into this world, but it's one of the things that you do become more aware of over time, right? Do the right things with that self-discovery that you have. If you're someone who takes a lot of risk in your life, this is the time to manage that like a big person. Okay. So at the end of the day, now we're going to show you why on a chart how on a chart rather, that we can manage all of the stuff we just talked about. All right. For those of you that are not in our Telegram group, it is a free group to join. All you have to do is click on that link. Actually, this presentation I'm going to put in this the description when this goes live on X. Or when I have a chance to get back and add it, but it will be there so that you can click on that link. And of course, if you're interested in any of our partners, they are here as well, just a click away. So let's get to now the fun stuff and get to the charts, because now we're going to show you how we manage the fear and the greed and all of those things that can make us crazy on the chart. And the reason that this indicator, and this is it in its simplest form, the reason I did it, really when I come back and think about it, it was so that I didn't have to think at all, right? I have enough experience. I have a methodology that I feel confident in. I know it works. But man, can I overthink stuff when I get in a trade or overreact and like I'm a human being, right? And how did I manage that? What you're looking at. Basically took my methodology and have it be representative of what's on my screen. So I know that, as you know, we're trading the T line here, which is the 80 MA, and we're using the 5 EMA as a trigger. And in our script, we get buy and sell signals, and we get early cues on when price might be changing direction, simply by the 5 EMA changing colors, right? This simply works, and that's why I continue to use it. And it takes all of the thinking out. So if I'm taking an entry signal anywhere down here, I have a means to manage and track price, just walking up the T line in the 5 EMA. I don't need anything special. I don't have to reinvent the wheel or anything like that. And you don't need a million things on your chart to establish trend. This, is obviously an uptrend. This is consolidation. And we know, because we use a volume profile, that this is the point of control, which is averaging the past price in volume here. And that's why it's flat. What's our takeaway? Well, if it holds, I interpret that as bullish, until we're told one way or the other what's going to happen here. And we can tell real quickly, almost at a glance, where price may want to go, because we understand we have some simple rules in technical analysis. We've identified a volume gap, and we know that's our downside risk. We're trading in an average range. This is the upper end of that range, and that's the lower end. Pretty consistent level down here at the lower end. And, obviously there's your top. This flat trading is stuff that we don't really want to get into, right? We're looking for breakouts and breakdowns. And of course, each and every candle looks like it's the one that's going to break out or break down, especially when things are flat. Now, this is a 4-hour candle, so if we were to back this up, let's see here. We're basically just getting one big red candle here all of a sudden. So where did we find resistance? Right up at the upper value range. Price came right back to the point of control. And on the 4-hour, that's what it looks like. That's why we look inside these candles one at a time. We know that the 1-hour candles come back to the point of control. Perhaps that's kind of, maybe we're going to get some confluence here, and the 4-hour starts to pull back as well. We don't know what comes after each and every candle. We can just go on what we can see. Until this starts to break down, well, I'm going to stay on the positive side. Right? What's it going to want to do if it breaks down? It's going to want to take out the previous wave's low. If it breaks to the upside, you're going to start looking at previous wave's high. Just one at a time, right? But this is the 4-hour chart that we've been using for quite a while. This is when we connected way back here in May, that second point. And then earlier in the week, I think we drew this line here. They're not just lines, they're levels. And they might not seem, well, although this didn't seem relevant back here when we first drew it, you'll discover as price continues its process that, hey, it's very relevant. And you're going to find it here too. So when we come back, yeah, we're going to look for this level. And if we break it, we have a bit of a problem because we're into a big volume gap. And we know what happens when price falls into the volume gaps. And you just have to pick a time frame that you can manage. Like if you can't manage the short time frames, pick longer time frames. Simple as that. And if you're using leverage, drop it. That seems to be the problem, right? Everybody uses too much leverage, and you come back and get bit in the butt by it. And that's not really what we want to do. Right? We want to be on the right side of price at the right time. This is Bitcoin. If you're trading the daily, whether spot or otherwise, even a little bit of juice, there's your entry candle. Back in, that's the 23rd of June, that big green candle showed up. So the 23rd or 24th, most people probably would have been diving on that bus. And you haven't looked back. All of this is still an expression of upward momentum. Price is trading on the north side, and there's still divergence between the two. That's just a means to filter the daily up and down noise. You're really concerned about the trend, and the trend obviously has continued to go higher. That's what the chart was telling. If we took off these candles and you couldn't see the daily nonsense or the intraday nonsense, is all you would see is the divergence higher? Right? At no time does the short-term 5 EMA break the T line. Almost kissed it, but it didn't break it, which means there's not enough momentum on price down to pull it and change direction. That's why I believe in this. Now, if this was the first time you saw a chart and someone said, all I need to do is make sure that I buy at the right time and manage my trade based on what we see here, they think you're nuts. But it's doable because you're concerned about the trend. Right now, are there candles that are volatile in between here and here? Of course. But that's why you run stops and you mitigate risk wherever you can. But at the basic simplicity is, if you've never looked at a chart before, if you're brand new, you can probably figure that, okay, this was a buy signal. And at a basic explanation of this divergence, you're like, okay, I guess I'm still in this thing. Like, we do make this a little more difficult than it needs to be sometimes. The problem is ourselves. We overthink, we take on too much risk, and so on, and so on, and so on. Right? We have seen these things many times. And they're real easy to avoid. Just do what you're told. If you want to know what's going on the daily chart, then just start to drop your time frames. Right? Oh, and all of a sudden, I don't know if you guys saw that, but I don't think that sell signal was there when I first turned this chart on. So what that means is that there's enough momentum to now pull that shorter time frame, 5 EMA, down through the T line. That's why it's flashing. Oh, there it goes. Now it's gone off. So we know there's something going on. If we continue to fall, we fall into that gap. And that becomes problematic. Now, if you remember last session, we were looking at the US dollar. Right? And we had kind of chosen, take the volume profile off because it doesn't like it. I think we ran fibs on this at one time. And I put that line on there later in the day. And when we, lo and behold, when we run the fibs, 618, which is kind of the retracement that we find as most common or standard or most acceptable, was literally right on top of it. So, we hit it. And here we are trying to figure out what we're going to do. Now, the reason I'm showing you this chart is because this is a setup that we see all the time. All the time. And you'll see this on shorter time frames, longer time frames. It does not matter. Right? So you've had a nice move down. And now, if you've been wanting to, this could be Bitcoin, it could be ETH, it could be FEG, it could be anything. Right? You have a nice move down. If you've been aching to go long, you're going to start to look at this and think that this is your opportunity. This is the mistake that a lot of traders make. So, they have the friend that says, oh, as soon as I buy, the stock goes down or the asset goes down, whatever it is. This is one of those reasons why. Because you're unfamiliar with what you're seeing on your screen. We know that as long as this divergence is in place, the tendency is bearish down. And quite often, after an impulse down, you have some sort of a sign of life that, in this case, essentially goes sideways. But what didn't happen is that there was no momentum to pull your shorter time frame up through the 8 EMA to start to give you a trend change. Is all that's happening is price essentially went sideways and could not break it. And we've talked before about, if you wanted to short this, this would kind of be an area that you want to do that in and around the T line and or the 5 EMA. So I kind of use these as re-entry zones when they confirm. Right? So we always talk about, don't get upset if you feel the move has already started to unfold. This is a setup where you could re-enter that with obvious success. And you're focused on the divergence and what happens with these candles as they get close to these ranges. If they start to fade, well, then you know that's a continuation down. And that's exactly what it did. But here we are on this 4 hour, and how many times have we seen this, right? Where price starts to break out, and then all of a sudden, it rolls over. And what are our options with price direction? Up, down, and sideways. Now, the divergence is here. Yes, we have some money coming in, and that's why the 5 EMA has gone from red to white. But we don't have a confirmed change in trend. And quite often we see price try to break out and then start to fade while this, of course, divergence was still in play and visible. And price starts to roll down. And then, of course, what happens? It's looking for the previous wave's low. Essentially, what you see here, taking out the previous wave's lows. This looks like the end of, at first glance, the end of this downtrend. This is where you have to be careful that this doesn't repeat and you get on the wrong side of it. Right? That's why, part of the reasons why we use this methodology. It's really easy. Real easy. So, you don't want to make that mistake. And how do you know what might be going on behind the scenes? Well, you drop your time frame. Just move to a 1 hour real quick. So if this is to fade, there's that previous wave's low we were talking about on the 4 hour chart. And, on the 4 hour, you don't have any sort of a buy signal yet or anything, nothing that's telling us that the trend is changing. Now, when it does, hey, we're there, right? That's why we do this. We're indifferent to price. Monetize the chart when it's friendly to our position on the way down, and monetize the chart when it's friendly to your position on the way up. Right? So what do we look for when we're trying to figure out what might be coming next? We're simply going to just add on, this is this 20-day moving average, simple moving average. Interesting, isn't it? So what do we know? Well, we know that first attempts typically fail. This may qualify, but I'm going to say no because the downtrend was pretty intense. I think what we're trying to do is challenge it in a meaningful way to end this downtrend at the 20. What happens? The first attempts typically fail. And when you break one level, you find the next. Right? And in this case, where's the next? Now we're just looking at past price, right? Unless we start to add maybe some longer time frames. Maybe that'll help us. Let's go to the daily. Weekly. Now, do you know how we talk about long-term moving averages and what they mean on longer-term time frames? Right? Let's just kind of recap that. Right? How many years is the 500-day on a weekly chart? It's about 20, 19 and change, something like that. About 20 years. And 1,000-day MA is 40 some odd years. Now, these white horizontal lines are just levels that I've drawn, and they're, there for obvious reasons. But do you notice how we have failed 20 years of price history? And we tried to break out on last week's candle, and we failed. Right? Literally failed right at it. Now, is that just coincidental? No, it's not. And right now, it kind of, there's the level that we had put last week, and it's obviously been hit. But this, I think, now is what it wants, is the previous wave's low. However, This is a 1,000-day moving average that just happens to be at one of the levels that I had drawn at around 90 cents. Now that's a terrifying level. If it, because we're talking about the US dollar index, right? So that's a terrifying level. But we're only concerned about the technicals, right? I only care about the chart. That's all that matters, is the chart, is price. Price matters. 1,000-day moving average on a weekly chart, that's 40 years. It's played with it many times before, right? Both of these levels. It's not the first time that you're seeing this. So you might be instantly saying to yourself, oh, that's not, the chances of that happening are pretty darn slim. Oh yeah? Condense your chart and you'll realize that it's not that slim. It feels unlikely, but what do we know about levels? What do we know about the language of the market? It's a real-time representation of what price is doing, not what people are saying. And it has ways of telling us kind of what it's going to do or what it may do. And there's a series of checks and balances that we can use to validate that. Right now, all I know about this chart is that this is a confirmed downtrend that failed 20 years of price history, and it failed. Like, the most concerning thing is this, failing to retake it and showing up this week with this candle. That's the concerning thing. This is still in a downtrend, right? This is a month of positive price movement, and it didn't change trend. Right? You've been told that this is still downward, at least for now. When the chart changes, we'll know. And to the downside, we have levels identified, but we do know that when we break one level, typically we find the next. So we will watch over time to see how close we get to these levels. Did they hit every time? No, but they act as a draw. And, we could put magnets down here and justify a draw right now for this thing. So price does what it does. We've identified levels. This level here, I know we talked about it probably months ago on it being structural. And if you broke it, it would be a problem. Is it a problem? Yes, it is. And it will continue to be a problem until it finds a place to sit. A bench of past price, something to catch its hat on the way down and try and build a base. But it just doesn't appear to be yet, at least not on the weekly chart. So these long-term averages, although they seem nonsensical at first glance, they mean something on the long-term time frames. They mean a lot. And on the shorter-term time frames, they help you identify ranges and targets. Okay. Now, let's take a look at Ethereum. Where is it? Here it is. And when we see the weekly for Ethereum, it looks like it basically caught fire. But one of the things we can tell as well is that there's a level here of, obvious resistance. And this chart, you can see this gap between the T line, the 5 EMA, and price. So that is a sign of something that's maybe just a little too hot that has to take a bit of a pause. This would have looked very similar back here. So would have this, so would have this. So when we're looking at ETH's weekly, we have to start to wonder if, maybe there isn't more of a pullback in order. Now, when we talk about these things, I don't want you to feel like they're the end of the world. Let's just look at what we know. We know on this weekly time frame that we're trading well above the upper value range. So essentially, this is kind of a premium. we know that price doesn't like to be too far away from the 5 EMA and or the T line. We can show you the same thing on the 20. Right, so the horse doesn't like to be too far away from the barn, and when it is, it'll come back to it pretty quick. So, you know, I wouldn't be surprised if we get that sort of a pullback. Why is this important? Because this is profit. So if this is what you're starting to think might be a decent setup on this time frame, now you have targets. Like sometimes I'll have orders in or exits at unreasonable places when I go to bed. Those reasonable places might be something like this, or you know, maybe a major moving average or an anchored VWAP or something, whatever it is, there'll be a target. Because every once in a while, you get this irrational movement in price that hits those levels. Didn't cost you anything to put it up there. And sometimes they get taken out. But I would be concerned a little bit that this might want to fade back to a minimum, the 5 EMA or the T line. And then what you have to be concerned about is, does this kick off a move down like we're seeing here? And if so, where does it go? Right? We see the gap. We know it's a premium. Here's your point of control. Another gap below, lower value range down here. Well, we talk about fibs, fractals, and filters. So let's use fibs. Let's just take the swing low, run it up to the swing high. We're 618 right here. What is that? 23.29. That's what the chart's telling us. So if this in fact is the top of this range, that would be a legitimate target. This would be a legitimate target. Obviously, the point of control is a legitimate target. And obviously, 618. You know, how you manage it once you're in it is up to you. But again, our job is to get you in at the right time, at the right place, get you ahead early so that you don't have to be stressed out by the fear, the greed, and the indecision. And is all you can do, or all you should be doing, is just managing your trade based on very clear, definable metrics. Right? That's basically all we want to do. Get you in early and allow you obviously to get out at the right time too. And the chart will tell us when that is. Does this not, you know, that's a, you know, a pretty aggressive run on the daily, but let's be honest, this is still a bullish chart on the daily. Entry signal, right here, up nice catch at the 1000 EMA, but here's your entry signal. The divergence breaks right away, and the greater the divergence, the more momentum. Here's your sideways action. Okay, this is the fear, greed, and indecision, right? Oh, I had a great run. I made a lot of money. And now I'm going sideways. Stuff should just go up like a rocket ship. All right, then take the darn candles off and just simply look at that. Because that's telling you that's a moonshot. Right? Clearly, that's one heck of an uptrend, and it still is. Don't be worrying about all the stuff. Oh no, sky's falling. No, it isn't. Oh no, sky's falling. No, it isn't. It's nonsense. Right? Block out the noise. Block out the noise. Everything that you need to know is on the chart. And that's the best part of this. Once you're comfortable and confident, you're communicating with the chart on an ongoing basis. It literally is a language, right? It's got things that it's going to do over and over and over again, and it tells us when it's going to do them. And we're capturing it by programming it. That's all. Or coding it, whatever you want to call it. That's what we're doing. Right? This is, remember we looked at this the other day. right? This is the ETHFi. And we talked about this being a target down here. You remember this chart? Right? Boom, there we go. That was a target for us. I'm trying to remember why that was. There's probably something down there that we were trying to capture. There we go. The 200 day. That's what we were looking for. And we found it. This is the range. Remember, this is a 4-hour chart. So if you're on a shorter time frame, and again, we use fractals here. We check and analyze the time frames ahead and the time frames behind us, right? We're forward thinking, and we're looking in our rear views to make sure we don't get hit by something we didn't see coming. But I talked about putting orders in at levels that seem unreasonable, right? Well, if you're looking at the 4-hour chart and you see the 200 there, like we did earlier in the week, you're going to go, you know what? That's got to be a target, right? Price is going to be drawn to these levels. Break one level, find the next. Well, here's the next. It just happened to find both of them in that candle. And here's the failed breakout that we showed earlier on something else, right? There's your bounce. Everyone's excited. You know, kiss and fade on the T line. Price rolls over, and what are you trying to do? You're going to take out the previous wave's low. This is not the first time we've showed this. Time and time and time again. So this is still bearish chart. You know, and now it's even more bearish than ever because you're trading below the lower value range. So this would all be interpreted as a discount on this time frame. But it also tells you that there's not a lot of love here. So if price comes back, takes out this previous wave's low, which essentially takes out the 500 day on the 4-hour, you're going to find the 200 again.